Hey, this is Trade Under here with Steady Trades. I'm here to talk to you a little bit about a straddle versus a strangle, when to use them. We're going to do some real life examples here of when a straddle is beneficial and a strangle is beneficial in options plays. Now, the first thing that we're going to cover is a straddle. Now, a straddle is an option strategy that involves the purchase of both a put and a call for the same expiration date and strike price, right? Versus a strangle. A strangle is a position of both a call and a put with different strike prices, but the same expiration date, and usually around the same cost, the same underlying asset. It's the same cost. That's all that's saying. So let's show you some real life examples and situational analysis of when to use each. All right, so we have SPY here up on the screen. Let's talk about a straddle first. Right? A straddle is used when there's high volatility in the market and uncertainty in the price movement. Now, this sounds similar to what the definition of a strangle might be, right? Except that it's more optimal to use the straddle when there's options that have a longer time to expiration. That's when they're more profitable. Now, the idea of a straddle isn't to be insanely profitable, it's to get profit regardless, right? So a straddle, you might only be looking for 10, 15, 20, 30% versus on a strangle, you have the potential to a couple 100%. Straddles cost more. You're looking for profit regardless. Strangles cost less. You're looking for more percentage, but because they cost less, your profit more or less maybe equal in the two. So it's up to you to decide which one works the best for you. Me personally, I like strangles. A lot of people like straddles because they get to invest a larger amount and get not a guaranteed return, but a near guaranteed return. It protects them if they know that there's going to be uncertainty and a lot of movement in the market, right? So this is SPY here. You could take a straddle, from July back here when the market was down and you thought the market was going to be back in the 400s and you were correct here, right? That would be a good option for a straddle if you took contracts that were further out. Let's show you why we want to take contracts that are further out. So here I have a straddle for SPY, and this straddle is closer to current expiration date. So that's the 15th of August. We can see that my net cost right here, my net debit for a $30 call and a $30 put would be about $418. If we were to go up less than 2%, we are not looking positive on the call side there. Downside, we look pretty good, but the call side does not look pretty good. And that's because the put is more expensive than the call would be there, right? So that's why it plays out that way. Now, if we were to change this chart range and add a couple more percent, we see some good profit to the upside. But this is SPY we're talking about. Do we expect a 3% change on SPY in a single day for the expiration of tomorrow? Not necessarily. It's always possible. It happens, but it's not what we expect, right? So let's go out to maybe August 31st instead of August 15th. This video is filmed on the 14th of August, so this is the expirations for tomorrow's contract. So let's go out to the end of the month, right? Here on a $30 call and a $30 put, we see that we have profit regardless in this small range, right, over the next couple of weeks. Now, it also keeps you protected if you don't really move that much, right? So if we have zero movement, net loss and profit is, our P&L is relatively small on the loss side. So, minus 10, minus 15, minus 20% we can cut, right? But it gives us a while to try to build up profit. You don't necessarily see profit on either side until you're over 2% here, right? But you're looking for a big move. So let's say that we think in the next couple of weeks, let's say this week we think the market's going to have a 4% up week, right? We're looking at 39% net profit. If we think we're going to have a 4% downside, we're looking at a massive profit there too, right? Again, in this situation, the put is going to be more expensive. The net debit is more expensive too, $1,200 per set. But we're looking to try to gain profit regardless. We think there's going to be some sort of massive movement, and we're giving the options time to play out. Now, let's talk about one of my personal favorites and what works for me better than a straddle is a strangle. So in a strangle, we're looking for volatility too, but we're playing puts and calls that are near the same asset price, meaning that they have nearly the same cost per contract. So here's an example on SPY again. The 423 puts, right, are about 52 cents, and the 430 calls are about 48 cents. That's pretty close to the same price. Now, all we need is a 1% move on these 0-day cons, right? These are August 15th to see some good profit. Anything over that, you got a lot of exponential profit here, 300, 400% across the whole day there. But if you stay closer to not really moving outside that 1% range, you can lose 100% of your spread as the day goes on. Now, it's cost us a lot cheaper though, $100, right? So where these are more beneficial, even more beneficial than playing SPY, is when you're playing, based off of maybe earnings movements, because earnings can have sharper movements overnight. So let's go back and look at Amazon here. Now, Amazon, when it had its earnings, right, a couple weeks ago on July 28th, we had a 12% move upwards on Amazon there, right? So let's look, what did a strangle do for us then? Or what could it do for us? Let's imagine that we didn't have this earnings yet, right? And that earnings is going to be this week. And this is, 12% move, very possible. We've had massive moves on Amazon from previous earnings, right? We know that a massive moves, it's 11.9% way back here on our earnings in April. We know that moves on Amazon like this, 10 to 12%, right? They're not out of the realm of possibility, right? It's completely plausible that these moves could happen. So let's pretend that this earnings right here didn't happen. Earnings is going to happen this upcoming week, right? So we say, we think there's going to be a 10% move either way, right? And we're not quite sure, right? So we're going to try to go about 10%, 8 to 10%, add the money here, try to make it a cheap spread and say that earnings is, this week. So here's the selection that I made. 134 puts and 152.50 calls. They're about the same price, right? $26 per con and $20 per con. That's as close as we're going to get. If we try to move it up a little bit more, we don't. It's kind of hard to get proper pricing on cons out this far. So we're going to keep it where it's at right there. This is a good situation, right? You can see that movement of 10 to 12% out of the money would get you massive profit either direction. Even movement 5% out of the money, right? Out of the current price range would get you massive movement right now. If you see an earnings that get you 12% movement in either direction, this is a 10x on cons, over 1,000%. So this is where strangles are pretty useful versus straddles. Now, again, it's cheaper. The net debit here is only $46. So that's why I prefer strangles. I like playing these cheaper plays or, a chance at higher percentages. But if you get no movement, right, you can lose the entire value. Unlike a straddle, right, or if you get no movement, you're still not losing your entire value until the very day that the contracts expire. You save a little bit of money here. You have a little bit of leeway in terms of how much you get chopped as you approach expiration, right? And with the strangle, there's really no leeway. If you don't get that drastic movement, you're losing pretty much the entire value of the contract. So that is kind of the downside of them, right? So the pros from a strangle, you benefit from the price direction, right? They're cheaper than straddles, and it does have unlimited profit potential, but it requires a big change in the asset's price. So this, I hope, kind of gives you a breakdown of where we like to use straddles, where we like to use strangles, and the differences between the two. And I would leave it up to you to decide which one you like better. Personally, I like strangles, but a straddle is a good investment opportunity that you can carry and roll over a week over a week over a week. Strangle is when you think there's going to be bigger moves than what there would typically be. So I hope this helps you to understand a little bit of the difference here. As always, we here at Steady Trades are here for you. If you need anything, reach out to us anytime at the Discord, email, anything, and we'll catch you guys later. Happy trading.